I want to bring in the chairman and managing member of Greta Capital LLC, Thomas Hayes, to talk more about what this all means. Hi, Tom. Thanks so much for joining us today.
Thanks for having me, Greta.
So what does this recent data that we've gotten show about the economy's ability to rebound as we do come out of this pandemic?
Well, the data continues to largely beat and largely improve, Greta. So as you said, personal spending is up 8.2% versus last month, negative 12.6%. Consumer sentiment rose 78.1 versus 72.3 last print. Durable goods orders, which is a leading indicator, was up 15.8% versus negative 18% last month. And manufacturing PMI, we're getting close to expansion at 49.6 versus 39.8. And new home sales was up 16.6% versus negative 5.2%. So the data is overwhelmingly good. It's improving. It's mostly beating expectations. This is just a short-term concern that we're going to see in fits and starts with different areas having spikes in cases. And what you see, Greta, when there are those spikes in cases is people get worried about slower growth. And that's kind of what you've seen in the last couple of weeks. In a slower growth environment, people gravitate towards tech stocks because they expect rates will stay lower, and that's where you're going to get the price appreciation, versus when things look like they're going to come out of the recession quickly like we saw last month, cyclicals outperform. And right now, we're at a really interesting inflection point. The ratio between growth stocks and value stocks is at historic highs right now, the relative strength of growth outperforming value. And the last handful of times that this happened, 2015, 2007, 1999, 1990, and 1987, in every instance that we got to this disequilibrium, cyclicals then took the placeholder and started to lead. So tech took a back seat, and you looked at cyclicals. And what's also, if you think about those years, those were years that you had a slowdown or a recession, and cyclicals and value tend to outperform coming out of recessions versus growth outperforming towards the end of cycles or in low growth phases. So that's kind of where we are now with the data and kind of with the table setting.
Tom, next week we're going to get more data, more concrete data on the impact of the coronavirus pandemic. Earnings season kicking off with big banks reporting at the start of the week. Again, those upcoming reports are going to be showing more of a real impact of the coronavirus pandemic. We got a little hint of that with Q1, but really getting that in Q2. What are you expecting to see, and what will be the reaction from Wall Street?
Yeah, well, we saw today actually the stress test results for the big banks. And what we're seeing here is an overreaction. What happened with the stress tests last night is that the Fed decided proactively, they decided to put a cap on the amount of dividends that they could pay out. They did not put a cap on the amount of money that the banks could earn. So as long as they're earning that money, which we're going to see on July 14th, Wells Fargo and JP Morgan are going to report their earnings, it really makes no difference whether they pay it out today or they pay it out in the fall. The other thing that had the market a little bit worried about the banks was that they decided to do a retest in the fall just to make sure as we're coming out of this recovery that they're well capitalized. But the theme of last night's results was that the banks by and large were more than capitalized in a very severe scenario, which we have not seen. And what you're going to see on Monday, as you pointed out, is more granularity on a bank-by-bank basis. And we'll see that most of these banks do not have to raise capital, number one. And number two, even the 2-3 banks out of the whole lot that have to cut their dividends a little bit. You take a Wells Fargo, people are saying, well, they might have to cut their dividend. That's not news. So their dividend right now is yielding 7.35%. Even if they cut it in half, which I don't think it'll be that extreme, you're still yielding well above the 10-year yield. You're trading at or to a slight discount of book value. And these are going to be the type of stocks that lead us out of the recoveries. The health of the recovery is equivalent to the health of banks. And you see that coming out of every single recession. And this time will be no different.
All right, Thomas Hayes, chairman of Greta Capital LLC, joining us to talk about Wall Street amid the pandemic. Thanks so much for coming on the show today.
Thanks for having me, Greta.
Want to see more videos like this? Click on the link below and subscribe to One America News on YouTube, and call your cable provider and kindly demand that One America News is added to your lineup. Call and subscribe today.